Show me some slides. There we go. So this, you're basically not only getting some updates on convention, we're going to go through depreciation. You get to see exactly how we run tax school right now. This is how it's done. And as Pam's kind of doing what she's doing, we've worked very hard and long hours and tirelessly to get tax school going between all 3 territories. And it is digital for Waycross and Jessup, which is new for us coming in the near future. These seminars are all online. It's a possibility that we may record them and just put them out and hold one session only in Brunswick physically to record. That may be in the future for seminars. So you're online if you watch it and there's usually a quiz, which online community that will be posted tomorrow, probably in between tax school classes. Give me a little bit of a break. Sorry about that. But you get credit if you do the pop quiz online, as if you were here. So the folks like Jim Mentor's online right now, Jessup ladies are online right now. All they have to do, I know they're in our office and I can hear them, but all they have to do is take the quick pop quiz and it will be random stuff. I don't know, has anybody taken the pop quizzes yet? I had one with Michelle's seminar that was, Michelle used this word instead of this word. What was it? What was the word? A or B? It was like she slipped up and said, I don't remember, was it like sessions or something, and she meant to say this. And I mean that detailed. So if I remember something quirky, I will pop it in there. So if you listen to online. So without further ado, I'm going to take this mic off. And there is coffee and everything up front. Okay, before I pass it over, I have 8 sets of tax school books left in the front. It's the basic course, it's 2014, and the resource guide. If you want it, we're actually letting you get them for $25 versus the $50, which is what tax school people pay for. But I have 8. So they are available. If somebody's not here, tell them. I know that Denise asked me for a set, and I hadn't seen her yet. So... No, it's got 2013's numbers in it, and the resource guide is a little bit different, but it's about the same. We still have Sparkle, the 2-year-old child actress, in there, and it's my favorite question in the whole thing. Sparkle. But, you know, if you guys want a set, let me know. Okay. So I've got it, and I actually do love the new credit card thing now. I got to tell you. It was so convenient. They walked in for tax. I'm like, stop. Would you like your books? Swipe. Here's your books. It was awesome. We're very spoiled. Our thing is up front and Waycross is in the back. Okay. Without further ado, I'm going to turn the camera around. Miss Pam Garcia. I think everybody should applaud. Yay, Pam. Let's not. No, applaud anyway. Pass the torch.
So if I'm not as peppy as Tina, I apologize. Well, I've had coffee too, but I've been fighting this, whatever this crud is, for at least a month. And so it's just hanging in there. So I apologize if I cough or clear my throat in your ear. I will try not to. I've got water up here. All right, so we're going to go through depreciation and basis today. This is not my strong point. So I welcome anyone giving any feedback. I know depreciation, I know basis, but I am not an expert in it. Miss Debbie, please, please, if you have anything that you think should be added, that, you know, we need to know that maybe I don't cover, please feel free to interject and let us know. Because you've seen over the years more probably issues with depreciation and basis than I have as far as on tax returns, what preparers often do. But we'll start out with basis. A brief description is it's just an amount of an individual's investment in the property for tax purposes. Usually the cost is whatever you've paid for that item plus any additional sales tax, freight and shipping, things like that. If it's like a piece of real estate, Then, of course, it also includes if you've made any improvements to it, any fence, roof, air conditioning unit, things like that. All right, so ways to determine basis. You have 3 different ways. You have your cost basis, you have adjusted basis, and then basis other than cost. So the first one we'll go over is cost basis. It's the cost that a person pays for the property. Like I said, it includes sales tax, freight and shipping, installation and testing, excise taxes, recording fees, and real estate taxes. When we talk about adjusted basis, that means that it's not just what you pay for that item, but possibly any improvements that you've made to that item. Improvement to a property, when you have rental property, you have repairs and you have improvements. And the way to tell the difference is a repair, of course, is when you go repair something, but it does not lengthen the property's life and it does not increase the value of the property. You're repairing something that broke, okay? If something has a useful life over 1 year, or it lengthens the property's life or increases the value of that property, just like you put a brand new air conditioning unit on a rental property, that's an improvement because the old one was wore out. Yes, it is a repair, but also because it adds value and lengthens that property's life, then of course it's an actual improvement, and that increases your basis in that property. You add it to your basis. Also, if it adapts the property to a different use, an example of this would be if I bought a van to transport patients in, and I added on the wheelchair accessible that allows the wheelchair, wheelchair lift and everything. That adapts that property to a different type of use. And so the wheelchair lift and everything that I add on there actually adds basis to that van. Decreased basis is a return of investment for the taxpayer while they held the property. This would be if someone, you bought some property and they paid you for easements. And you, go on to the next slide because we've got some examples on here. All right, so the decrease to basis would be casualty or theft loss deductions, insurance reimbursements, tax credits, certain canceled debts, and like I said, the easement. Whenever, say, the electric company pays to put a road on your property, you're getting a return back for that. They're paying you to be able to drive and to build that road onto your property. Same with sidewalks and things. Increase to basis would be capital improvements such as putting addition on your home, replacing the roof, paving your, and it's the entire roof, not just repairing a section, it's the entire roof. Paving your driveway, installing central air, rewiring your home, assessments for like water connections, utility service lines, sidewalks. This is when you have to pay additional money, and for roads, not them paying you, okay? Because if they pay you, then of course it's a decrease to basis. But when you have to pay to get connected to city or county water, you have to pay to have sidewalks put on your business property or have roads built in there. And of course these are assessments for local improvements, and that increases your basis in that property. Casualty losses, restoring damaged property. Of course you have to subtract out any insurance reimbursements that you have, and also zoning costs whenever you're rezoning a property for business. Okay, so the other one we have is basis other than cost, and this is when you can't use regular cost basis. You received, as payment for services, you received an item, you received it as a gift or an inheritance. So property received for services, we talked about this in tax school, it's bartering. If maybe I'm a plumber and I do some plumbing for someone, and in turn they give me some piece of property, it's worth $1,000. I did $1,000 worth of work for them to be able to obtain this item, then my basis in the property would be that $1,000 because that was the value of the services that I gave them for that item. So it's always the fair market value of the services that I gave. Right, so property received as a gift. To calculate the basis of property received as a gift, you have to get the following information. You have to know the donor's adjusted basis right before they gave you the gift, the fair market value at the time of the gift, and the amount of any gift tax paid. This makes it a little trickier whenever you're trying to figure this. I do have a sheet that I gave you. It is this one with the little small table. It says property received as a gift. Down at the bottom is a table of how to figure whether you take the donor's adjusted basis or the fair market value. And we have an example coming up. All right, so if the fair market value of that item is less than the donor's adjusted basis, what the person who gave it to you, what they have as basis in that property, if the fair market value is less than that and you sell it at a gain, then you use their adjusted basis. If you sell it at a loss, then you use the fair market value at the time of the gift. If the fair market value is greater than or equal to the donor's adjusted basis, and you sell it at a gain or a loss, you use the donor's adjusted basis in both instances. Then we have an example here. Katie received a boat as a gift from her grandfather. The boat had a fair market value of $8,000. The donor's adjusted basis at the time of the gift was $10,000. So if she turns around and sells the boat for $12,000, there's a $2,000 gain because she must use the donor's adjusted basis. However, if the boat sells for $7,000, which is under the fair market value, she'll have a $1,000 loss because she has to use the fair market value at the time of the gift. If the boat sells for between $8,000 and $10,000, she does not have a gain or a loss. Now, you know, Profiler figures all this for us, but you will need to know the fair market value of that item, and then, of course, the person's basis, the person who gave it to you, their basis in that item, what they paid for it, plus any improvements that they made to that item. So if her grandfather had put a GPS unit on it, let's say he put a fish finder on it, he had the seats reupholstered, that would all be bases in that property. So whatever he paid for the boat plus any of those items would be his basis. Right, so inherited property, it's usually fair market value of the property on the date of the decedent's death. That's almost always the case. There are certain times when the executor of the estate will have an alternate valuation date. This is to help save on taxes for the estate. It's very rare that you have this, but just understand that it can be one of the two dates. Usually it's almost always the fair market value on the date of the decedent's death. Like I say, you can have the alternate valuation date, and that's determined by the executor of the estate. If they would let you know. All right, so we have a question. Joan purchased property that cost $500. In addition, she paid sales tax of $25 and shipping charges of $10. What is Joan's cost basis in the property? $535. That is correct. Okay. All right, so Bert paid $30,000 for a 15-passenger van he used in his medical transport business. He spent $7,000 to have the van modified to be wheelchair accessible. What is Bert's adjusted basis for the van? $37,000, that is correct. Okay, so which of the following is an instance where cost may be used for basis? So we know if property is received as a gift, there's certain rules that we have to follow, and we can't use the cost basis. If it's inherited, it has to be the fair market value on the date of the decedent's death or the alternate valuation date. That's true. Property purchased on the internet, because property received for services, we have to use the fair market value on the day that we actually perform those services. All right, so now we'll go into depreciation. It's an income tax deduction that allows the taxpayer to recover the cost or other basis of certain property over time you use the property. An example is, I buy a forklift, I pay $10,000 for it. We'll just assume it's a 10-year property. I get to take $1,000 per year for those 10 years. You know, there are cases where we can take it all in the first year if it's certain type property. We have to look at it and see which one's better for the customer. This is an annual allowance. Depreciation is for the wear and tear, the deterioration or obsolescence of the property. Obsolescence refers to like software and computers. You know, you buy a computer or let's just say a cell phone. A year later, you know, it's really obsolete because they've already come out with something new and better and faster, and so that's the obsolescence part of it. It includes tangible property, which is something you can feel. It's something physical, and intangible property, which is like copyrights, goodwill, trademarks, things like that. Okay, so tangible property examples are buildings, machinery, vehicles, furniture, equipment. Of course, we cannot depreciate land. That's always been a given that we cannot depreciate land. We can depreciate the buildings on the land. So anytime that we depreciate a building, we have to be sure to separate out the cost of the land. Usually it's on the property tax form how much the land value is. We can always look on there. But that's how we figure that. We only depreciate the buildings that are on the property. Intangible property include patents, copyrights, computer software, like I said, trademarks, goodwill. Can you think of anything else, Miss Debbie? Okay.
When would you decide to depreciate computer software? Because usually I just put that as an expense.
Usually Section 179 it. We do. Oh, I'm sorry. The question was, when would you decide to depreciate computer software? Probably, I have been where they've spent a lot of money on computer software. An example would be when I worked for Gulfstream. They had an engineering CAD software. Very, very expensive. We're talking about, you know, a couple $100,000 for this software. So in a case like that, you would want to depreciate. You know, that's for a large corporation, of course. But if you're just buying QuickBooks and it's $150, $300, then yeah, you probably want a Section 179 and go ahead and just expense it all out at one time in that first year. Okay? But you can make that choice, whichever's better for the customer. All right, so to depreciate, you must meet these requirements. The taxpayer must own the property. They must use the property in a business or an income-producing activity. Dual-use property, which means it's for personal and business use, must be adjusted for the amount of business use only. In other words, you can't take depreciation for your personal use of that item, let's just say a computer. Property must have determinable useful life, and they must be expected to last more than 1 year. Okay? So depreciation begins when a taxpayer places a property for use in a trade or business or for the production of income, and it ends when either they have fully recovered the cost. Like I said, if they bought a forklift, they depreciated it over 10 years, $1,000 per year. At the end of that 10 years, and they fully recovered their costs. They've gotten the tax benefit for the whole amount that they've put into that forklift. So that's what fully recovered means. Or when the taxpayer retires it from services or disposes of the property, whichever happens first. Okay, so we're talking about depreciation beginning. Callie bought a key-making machine for her hardware store she owns. I'm sorry, I'm like getting warmer and warmer. Sorry, online, I had to turn on the fan. Okay. I'm fixing to start clothes here. I've got on a couple shirts here, and I'm about ready to take the outer one off. All right, so Callie bought a key-making machine for her hardware store she owns. She ordered it on May 1st, and it was delivered on June 16th, but wasn't installed until July 7th. So you look at that and you go, okay, what date do I use? She made her first key, and I put an extra L in there, Callie, made her first key for a customer on September 4th. The date the key machine was placed in service, so that was the date it was installed, was July 7th. So that was the first day she. So being that that's whenever it was actually installed and was available for the intended purpose, that's whenever you use, that's when depreciation actually begins. The fact that Callie did not use it until September does the date the machine was placed in service. If she does not make another key for 6 months, she still continues to take depreciation because the machine is ready and available for use. So even if you go to, say, you know, it's a new hardware store, and a lot of people don't know she makes keys because it's a new machine, just because she takes a temporary, it's sitting there and not being used doesn't mean you can't take depreciation on it. You can still take depreciation as long as it's ready and available for use. It's only whenever she says, okay, I'm done with it, it needs repairing, it's broken, whatever, that's when she takes it out of service, that's when you actually do the depreciation on it, and then you do a disposition on it. Okay, so depreciation ends when you fully recovered the cost, when the total of all the depreciation equals your basis or your cost in the property, when the item is sold, exchanged, or destroyed, it's converted to personal use or abandoned. And whenever depreciation ends, you have to do a disposition of that property. We have a lot of people who go and just delete the item out of there. Oh, they don't have that anymore. Delete, and they delete it out of Profiler. You can't do that. The IRS is going to go, all of a sudden it's not, they can't into this item. This is incorrect. After this property.
One question for you, Pam.
Yes.
I got a guy that's
Hold on. Let me let you. So I don't have to repeat. Yeah, you get to talk in the mic.
Oh, thank you ever so much. Speaking to the mic.
Yeah,
Here you
laughing
go.
at you.
Yeah, all right. I got a customer that's in the dirt hauling business, and he's quit because he hurt his knee, but the truck is already depreciated out, and it's shot. Okay, I mean, it has no value except maybe if you sold it for scrap.
Okay.
But he's still got it sitting in his house. So it's depreciated out. He hadn't disposed of it. Where am I?
Well, basically, it's converted for personal use, I would say. Wouldn't you, Miss Debbie? Yeah. At that point? Because he's not using it for business. He hasn't actually sold it for scrap or anything. So basically, and he's not in business anymore, so he's converted it to personal use. Even though it's sitting in his yard, it's a decoration in his yard, so it's his personal use.
So if he wants to sell it.
Hold on, Miss Debbie.
Okay, if he was to sell the property now that it's in personal use, is it correct in saying that what he receives will be a 100% gain because everything's been written off on the company side?
That's true, because he has to recapture that depreciation from what I understand. Is that correct?
Yes.
Okay.
I understand that when he sells it, but if